Su-Lin Ong is the chief economist at RBC Capital Markets. Was a rate increase of this size today expected?
There was some speculation amongst market participants about a larger increase, 40 or 50 basis points, but the RBA had signalled a preference for 25 basis point moves, so quarter point moves. So it was a little bit surprising that they opted for such a large increase today of 0.5%. It really has stepped up the pace of tightening, and it does leave the door open to further hikes of this magnitude.
Well, I know this is a little bit of crystal ball gazing, but a lot of Australians watching would be wondering how far are interest rates going to rise and how quickly, and where are they likely to end up and settle?
So the key rationale behind this large move today was an increasing concern around inflation. And there's multiple factors that are driving higher inflation, whether it's ongoing supply chain disruptions, the war in Ukraine, rising utility prices. They're all coming through, and that concern is very much driving this larger move by the Reserve Bank. So their sole aim now is to try and get inflation, which is already above 5%, back into the RBA's 2 to 3% target range. To do so, it needs to get rates higher. It can't do a lot about some of those factors driving higher inflation, but it can temper demand and increase borrowing costs, squeeze households a little bit in terms of their disposable income, and slow the economy and prices that way. And so we do expect the bank to deliver further hikes, multiple hikes in the coming months. The door, we think, very much is open to another 0.5 point increase in July and further hikes thereafter, to get the cash rate, which is currently 0.85, to just above 2% later this year.
You mentioned the external factors such as the war in Ukraine and supply chain issues. What happens if the Reserve raises interest rates and it doesn't have that much effect on inflation because those factors are external?
That's very true. I think the RBA, as well as other global central banks, are very aware that there's only so much monetary policy can do to affect some of those price pressures in terms of supply chain disruptions, war and elevated energy and commodity prices. There isn't an awful lot that central banks and the RBA can do on that front with the instruments that they have. But what they can do is use interest rates to temper demand.
When you look at the size of the average Australian mortgage against the average Australian wage, is an interest rate increase of this size likely to start putting people into mortgage stress?
Look, I think there will be pockets of stress, but at the aggregate level, we know that households, and in particular their balance sheets, are in much better shape than we've seen for a very long time. And that's really a function of what has been a big build-up in household savings over the last couple of years. It's about 300 billion Australian that has been built up. It's about 13% of GDP. There's a pretty decent financial buffer for households to meet increased mortgage repayments, as well as other shocks, whether it be from fuel or higher utility prices. So on aggregate, we think that that households and the economy should be able to cope with mortgage rates that lift up further, a cash rate that is a little above 2% later this year. But there's no doubt there will be some that are in a bit more stress. Those that came into the market late, had smaller deposits, that are in less strong employment conditions. They will feel, we think, some stress.
Su-Lin Ong, thank you very much.
Thanks, Leigh.
Hi, I'm Leigh Sales. Thanks for watching this story. If you'd like to watch more of 7:30's stories, they are on the left of your screen. And tap on the button below to subscribe and get the latest from ABC News.